asset markets at this point in time. But yesterday, after market hours, we got three big private sector banks announcing cuts in their deposit rates. Of course, this has been preceded by some of the state-owned banks, PSU banks, already cutting their deposit rates, notably among them being State Bank. But yesterday, all three in a row, that was ICICI, HDFC Bank and Axis Bank cutting rates. So we have one of the men who probably took this decision for his bank, Ashish Parthasarthy of HDFC Bank, joining us. We will also be in a bit joined by Vaibhav Agrawal, the banking expert from Angel Broking, to tell us how he's looking at the banking stocks. But Ashish, you go first. What's the trigger for this rate cut? Is it that not many people are taking loans?
Well, I think 2-3 factors. If you've seen, month of August has seen much better liquidity. We've seen short rates in the markets come off. If you see, look at CD rates, CP rates. And yes, August has been a month where the deposit growth has been much stronger than anticipated and credit growth slightly less than anticipated. So all these put together has eased liquidity not only in the market, which is the primary liquidity, but also liquidity on the bank balance sheets of banks. So that's the reason for the rate cuts.
Okay, but Ashish, this August liquidity was always expected. The Reserve Bank's dividend would be paid out. There is one auction less in the early part of September. So this kind of liquidity was expected. Now we will get into advanced taxes and we will get into the new borrowing season. Are you expecting liquidity to remain comfortable even in the months to come, since you all have taken a slightly long-range decision of cutting deposit rates? Would the comfort of liquidity in August be reason enough?
See, I made 2 points. I think one is primary liquidity, which we are talking about, market liquidity, and another issue of banking balance sheet liquidity, which is the growth of deposits versus credit. So both happened, so the growth of deposits have been strong, the month of August. So while going forward, yes, liquidity will become less than what it is today. However, we expect the banking system liquidity or banking balance sheet liquidity to be reasonably comfortable, because credit growth has slowed down a bit in the system.
Okay, so Mr. Parthasarthy actually just wanted to take that point forward and had two questions. One, what is your estimate for credit growth in FY13? What you're estimating at this point in time vis-a-vis your earlier estimates? And two, the deposit rate cuts. Would there be a possibility that you would reverse them once the liquidity situation changes?
Two things, okay. As far as credit growth is concerned, our estimate has been, around 17% year-on-year growth for the system. We are still sticking to that estimate, but there's a likelihood, we are saying there's likelihood of it being lower, and maybe it would be around 16% by the end of the year if things don't improve in terms of, the investment climate. If there are new investments, we could easily get to 17%, but if the investment climate remains where it is today, I think, we would see a lower credit rate growth. As far as a reversal of deposit rate concern, I look at that as a very unlikely move in the near term, because if at all we know policy rates, if at all the next move will be down or they may remain here. Liquidity, there have been liquidity measures by RBI which will keep the system liquidity comfortable, in sense at least the rate anchored, the overnight rate anchored, because of availability of liquidity from RBI. So given these things and given the lower than anticipated credit growth in the system, I think deposit rate cuts are here to stay for some time.
That was actually my next question, Mr. Parthasarthy. Do you expect that you will follow this up with a base rate cut? When I say you, I mean the industry. Could we have seen individual sector lending rates getting cut, but not the base rate. Will that come? And is this the first of some more deposit rate cuts, according to you?
Okay, as far as base rates are concerned, some banks, including us, we did cut our base rates during this financial year post April policy. Of course, it took time, because it takes time for the deposit cost to get reflected into there's a formula, into the base rate formula. Given that these cuts have happened, I think down the road, yes, there could be some more base rate cuts, either from the banks who have already cut rates or banks who have not moved at all. So I think next 2 odd months there is a possibility of base rate cut in some to some extent. As far as loan growth, yes, you've seen loan rates come down in specific sectors, and that's likely to be where it is.
No, I mean also further
deposit rates. Further deposit rate cuts, I think that would then depend on how the policy rate moves. If the policy rates remain unchanged as what they are today, in my personal opinion, I don't think we'll see any major deposit rate cuts going down the line.
Okay, so Mr. Parthasarthy, just give us a sense in terms of what exactly your cost of funds are at this point in time, and what would your estimate for NIMs or margins be for the remaining part of the fiscal?
See, I don't have the exact number for cost of funds, but as far as NIMs are concerned, see, we have operated in a NIM range of 4 to 4.3% for the last several years, and we will continue to operate in that range. There will be quarter fluctuations, but over a period of every financial year, we are going to be in that range, and both lending rates and deposit rates will get adjusted to market conditions, and we are quite confident of maintaining that NIM range.
That would be less of a confidence perhaps for the sector, Mr. Parthasarthy. So let's get the sector expert in at this juncture. Vaibhav, what is your sense now that it's well and truly that the deposit rate cuts have started? Should one therefore expect an improvement in margins? How does this cycle invariably impact margins? Because almost no one has cut their base rates. They've only cut their deposit rates. So is there an immediate improvement in margins?
Well, when it comes to the deposit rate cuts, I think the reason these have been triggered is not so much because deposit growth has been high, but because credit growth is actually coming down. So clearly, in terms of the environment for banks is not really very positive right now. From the margin point of view, we are factoring in sort of stable margins going ahead. But relatively, the smaller banks which have a higher reliance on wholesale deposits, they could see a margin improvement. For instance, for some of the private banks such as Yes Bank, we are building in about a 15 to 20 basis points improvement in margins over the course of the year.
But, we have seen several product prices getting cut, auto loans, home loans, and in several cases, very obviously, the finance minister even said in Parliament that he has asked for these kinds of lower pricing. So, do you think that public sector banks would be more under pressure? And basically, how are you looking at lending rates? Even without the base rate cut, are banks actually lending at lower rates to a large part of their customers, if not all of them?
See, this is, inevitable because, looking at the way the credit, growth has been, if you see YTD, it has been almost negligible kind of growth in credit, and clearly the pipeline also, as indicated by banks, is quite weak. So, as credit growth continues to come down, possibly even below 15% by the end of the year, clearly there will be, some degree of price competition between PSU banks to, garner a certain amount of balance sheet growth.
Mr. Parthasarthy, I just wanted to actually focus on a bit of a short-term issue, which is basically credit growth in the festive season. I wanted to take the point forward with regards to lending rates. Do you think that there is more room at this point in time for you to possibly reduce lending rates further in order to boost credit growth in the short term for particularly the festive season?
See, as far as our bank is concerned, our credit growth credit growth has been on track as we have planned. So, purely from our bank's perspective, unlikely that would be the case. However, if the market rates goes down and everyone in the market cuts rates, we obviously will have to move in that direction to maintain our share of the market and reach our targeted rates of growth.
As Ashish has been saying, as Vaibhav pointed out, the manner in which bankers tell us about the complete lack of demand for loans, the prospect of loan growth going to 15% towards the end of the year can't be ruled out, you think, Ashish, and therefore what can be the impact on yields? Do you think that there is going to be a secular pressure for yields to fall?
If that is the state of the economy where credit growth falls to such a low level, that obviously means you are seeing a much lower GDP growth than what has been projected so far. So obviously in such a scenario, you'll obviously see downward pressure on yields on the long term.
No, but what's your guess? Is that your base case that things could snowball into yields falling towards 8% or lower?
That's not our base case. Our base case projections for GDP is 5.5% for the year, which is low but not extremely low. We are not expecting huge amount of fall in inflation, so inflation will remain where it is. We are slightly optimistic on the growth in the second half of the year, towards the end of the financial year. So we are, if at all, we are not as pessimistic to project 15% credit rate. We think at least it will be around 16 to 17, that ballpark range. So given that, we expect yields to be steady. We don't expect rise in yields and bond yields or a sharp fall in yields. We expect them to be range bound. Yes, 8% cannot be ruled out, but we would expect the range to be more like 810 to 840, that kind of a broad range during the rest of the financial year.
Okay, Vaibhav, just give us a sense. Yes Bank in this particular environment or in this particular scenario is your top pick, but give us a sense about other private banks. How exactly would you be placed on the likes of Axis and ICICI, and what would your top picks from the PSU space as well be?
Yeah, within the private banks, the other two names that you mentioned, ICICI and Axis, also from a valuation standpoint as well as earnings growth, clearly look better than the PSU pack. So, they still remain a buy for us. Within the PSU pack, we are increasingly, cautious because we expect NPA pressures to continue for a prolonged period, and so we are quite selective within the PSU space. Within that, I think what an investor can do is really, bottom fishing and value buying, and from that standpoint, we like Punjab National Bank and Union Bank within the PSU pack.
All right, so that's definitely the tide turning in favor of picking some value at the bottom of the heap. Thanks a lot, Ashish Parthasarthy and Vaibhav Agrawal, for joining us in this discussion. So that's the word. We could see a cut in base rates as well, but further cuts in deposit rates would be contingent on the Reserve Bank moving policy rates. Take a break on that note.